Hello, everybody. This is Ken Weber, president of Weber Asset Management. I'm here once again in New York, just outside of New York City. Today is, what's today's date? Today is April 14th. It's Tuesday, and it's just afternoon here in New York. And I'm talking, of course, once again to my partner and friend, Jack Bowers, Chief Investment Strategist. Hi, Jack.
How you doing?
And tell us where you are today, Jack.
Oregon Coast, visiting some family members, and be back on the road, back to the office tomorrow.
And I am certainly practicing social distancing. There's no one here in the office building within sight. So generally I'm staying home. So we're trying to do our part here in New York. And I know Jack is out there as well. So we're going to jump right in and talk about the current situation. Jack, the first thing I want to talk about a little bit is bonds. Bonds a week or two ago behaved a little bit erratically and a little bit unexpectedly. So just touch on what you see happening in the bond market now and in the coming weeks, if you don't mind.
Sure. A lot of this played out during the financial crisis in 2008, 2009. So it's something we've seen before. When you have a situation where there's a high level of bankruptcy risk, there is always concern that the underlying corporate bonds in a particular bond fund may not be able to pay the principal and interest. And so what is normally investment grade type credit ratings can be perceived and behave like high yield bonds. And we saw this in a very widespread way the last few weeks. Not just with high quality corporate bonds, but also with municipal bonds, and of course high yield bonds themselves took a fairly heavy handed hit as well.
And now?
I think, generally speaking, high yield bonds recover faster than the stock market in past major bear markets, typically within 12 months. And during the financial crisis, all the investment grade bonds that took a significant hit in the financial crisis recovered in about 6 months. So by summer of 2009, valuations had largely returned to normal. And I think we will see something like that this time play out similarly. It could be an even faster recovery because the Fed stepped in and backstopped high yield bonds on Friday. And I think that takes a lot of credit risk off the table.
Right. So I would say the clear majority of our clients do have some bonds in the portfolio, as we've tried to reduce risk for many clients who want some downside protection. So even though there were some hits early on in this downturn, it looks like now the bond market has stabilized and the bonds are doing what we wanted them to do for our clients, giving them that buffer against the downside. And I think actually the results have shown that over the last couple of weeks, correct?
Yes, we had a wave of liquidity problems until the Fed really stepped in and announced first that they would be buying investment grade bonds, and then later on Friday that they would even dabble in high yield, basically backstopping pretty much credit across the board in the corporate bond space. And so I think with that, we've seen kind of bonds go back to kind of a normal behavior. They are, of course, the spread between government yields and corporate bond yields is still very large compared with normal, but I think a lot of that will go away over the next few months as people understand which companies really face bankruptcy risk versus those that are perceived to. And as that happens, we'll see, to some degree, bonds moving in lockstep with stocks during a potential recovery cycle.
So you're saying bonds did their job protecting on the downside recently, and as the recovery slowly starts set in, bonds and stocks will move together. Traditionally, that's not always the case, but you're seeing something a little different in the coming weeks and months.
That's correct. Normally, bonds are negatively correlated to stocks most of the time, meaning that if stocks go down, the bonds are generally going up a little bit, or if stocks go up, the bonds are usually moving down a little bit. And in this case, we have a situation where the perception is that the credit risk is so great that bonds are behaving like very conservative stocks in a way. And that's something we saw also in the financial crisis. It's something we saw a few weeks ago. But it was not very long lasting. As soon as the Fed backstopped corporate bonds, liquidity returned to the market. Prices immediately moved much closer to normal, and I think there's still a little bit of recovery that will play out in the coming months.
Great. So now let's move to the bigger side of what Weber Asset does, which is stocks. The stock market has been very volatile, but recently it's shown some strength. Let me just say that I don't make forecasts, but I did make some forecasts. I think I even mentioned some last time that we had this video. I said the market at that point had dropped a 30 or 35% from its peak. I said 50% off the peak would be its floor. We didn't come close to 50% off the peak, and we've rebounded some. I think there's going to be a lot more volatility, but I think and hope, but I have reason to think that the worst is behind us in terms of the downside. What do you think, Jack?
Well, yes, I was worried after that first bounce off the bottom that the market might retest its lows if the number of daily new coronavirus cases didn't peak as expected, but it did. So that means at least the stage is set for the economy to begin reopening in the second quarter, by the end of the second quarter. The other factor was that early on in this, the stock market was reacting primarily to bankruptcy risk. In the financial crisis, we had maybe 1 in 6 companies that did not remain solvent through the whole thing. And I think the perception of a lot of people in the stock market was that this was going to be a lot worse than that. I think now that the Fed has stepped in with its Main Street lending program, and in buying high yield bonds and buying investment grade bonds, it's pretty clear that companies will get the liquidity they need to survive the next few months. And so this allows the market to begin, pricing stocks based on the assumption that most companies will survive and that corporate earnings will largely return to normal within 3 years, maybe sooner. And as a result, we've seen a pretty fast and strong rebound. This is one of the reasons we didn't make many changes on the stock side. I think we were heavily tilted toward growth stocks, which were holding up better than value stocks in the downside anyway. So we didn't feel compelled to make any changes, and I didn't think it was necessary to try to become more defensive the way things were playing out, because the market had already reached oversold levels very quickly, and I didn't want to be in a position where we tried to make a defensive move and ended up selling right at the bottom. And I think with the Fed stepping in the way they did, that was the correct course of action. I have looked at some options like rebalancing from bonds to stocks, but the risk numbers have gone up for a lot of bond funds. So we really don't have the bandwidth to be able to do that within our current risk profile. So really this is just about kind of sitting tight, making sure that the current mix of funds we're in still makes sense. And at this point it does. I think there are some interesting opportunities out there, especially in the retail leisure sector. But it's probably too soon to act on those at this point in time. The big focus right now, I think, is on the second quarter or the first quarter earnings season. There's going to be a lot of good information in the sense that a lot of people are expecting bad things to happen across the board, and a lot of companies are going to come out and say, in effect, we don't see any problem with surviving the next few months. And I think that is going to be putting things in more perspective for people that are just assuming the worst is going to happen.
Right. So there's a couple of things here. Many mom and pop shops are going to be in trouble over the next 6 months, 12 months. And that's going to be a drag on the economy. Larger firms are going to be backstopped by the federal government and state governments, perhaps. So there's that dichotomy of big versus small. But one thing I want to stress to our clients is that the stock market will recover well before the economy recovers. So the economy could see, for example, unemployment rise to 8, 10, 12%. I'm not saying that's going to happen, but it might. But
yeah, maybe even 20. Yeah. To my mind,
is going to look past that.
Right. But the employment numbers have to be, to some degree, taken with a grain of salt, because we have this program where the federal government and the Fed are stepping in with these furlough programs that largely cover employee salaries for the next few months. And it's a way of helping the employees. It's also a way of helping the businesses indirectly. Companies that may normally have remained shut down with paying the full payroll that might have gone bust can now furlough, knowing their employees will get paid through this program, and then they can bring them all back when the time comes. And it's actually a very good way to handle the whole thing, but it does inflate the unemployment numbers because you have all these employees with permanent jobs and sometimes continuing healthcare benefits that are showing up in these unemployment numbers during the furlough period. So it looks like a depression, but it's not. You have a situation where there's a very temporary thing going on, and when employers are allowed to restart, then they'll gradually bring back their furloughed employees. And it would not surprise me, a year from now, if 80% of the furloughed employees return to the employer that they had before.
Right. And many people will, over the next few weeks, decide to move in different career directions. They'll look for other opportunities. I hope that's what happened. I certainly know people in my circle who are doing that, who are saying, well, I was going in this direction, but now I'm going to go in that direction. And hopefully that will work out for many people. I want to congratulate many of our clients, by the way. We've had very few panic. We've had very few, as we did in 2008, 2009, call and say, I got to get out, I got to get out. That really has not happened. I wrote the book called Dear Investor, What the Hell Are You Doing? Which was predicated based on exactly what happened in 2008, 2009, when people locked in their losses right near the bottom. So we're very happy that our clients seem to have learned the lesson of 2008, 2009. And I think most of us will get through the churning that's going to happen, that has happened, and that will happen.
Yeah, I would like to add, one of the most important things is to have people correctly positioned from a risk tolerance standpoint.
Absolutely.
As long as people are in the right models with the right percentage of bonds, our models have behaved largely exactly like they're supposed to. We got a little bit surprised on the high yield side, but the risk numbers were on target, and what we saw on the downside, was very predictable based on the risk tolerance numbers. So nothing unexpected has happened given this situation. So that's one of the reasons we haven't felt like we need to make any adjustments at this point, because we're in a good position for rebounding, and we didn't take any more of a hit than we should have taken for the given risk targets on the way down. And
that's an excellent point, Jack. And yes, back in the Great Recession, a number of our portfolios, for various reasons, did not perform as we hoped they would. That has not been the case. We've adjusted it. You've made changes. We've all made changes, and we've been very careful over the intervening years, as you said, to make sure our clients are positioned on the risk ladder in the most appropriate risk level for their situation. And combination of the people being positioned correctly and of the portfolios themselves performing as we wanted them to perform. That combination, I think, has helped ameliorate any sort of panic, and people are much calmer this time and looking past the churning that's happening right now.
Yes, it allows you to take a long-term view of how things are going to come out on the stock side, and that's really what you should be doing anytime you're in the stock market. Right.
Just want to briefly touch on the energy field. That's one of your areas of interest, as always. Been a lot of headlines about oil. So just the last thing we want to touch on is talk to us for a minute or two about Saudi Arabia and Russia and that whole mess with OPEC.
It's been fascinating to watch. I had this view of how disruption might play out as the transportation gets electrified, and how we might have 3 million barrels a day of excess oil production and what that would do. And it's like, this is like 7 times larger than that. There's probably a good guess would be 25 million barrels of excess production, because the transportation system is largely shut down and people are staying in their houses and not moving around. So it's kind of tough for the oil producers, because if you shut down your main producing oil reserves, it can be tough to get them back going again. And so every producer would like somebody else to cut, but if the reality is the world's running out of storage space, and within a week or two, there's going to be nowhere to put any of this. So those 25 million barrels get cut either in a disorderly way or an orderly way. But the producers all know we need to work together to get these, the production rate down, to get it in sync with the current situation, or it's going to be very hard on whoever bears the burden. So I think the U.S. producers are in reasonably good shape because the shale drillers just stopped drilling, and there's a natural decline in output. But I think for the Saudis and the Russians, they've got traditional oil operations, and it's harder to cut those, but it has to be done because they're just not going to have anywhere to put it. So I would imagine that'll play out in the next week or two. There's virtually no way they can avoid the cuts because there's no space. This pricing is such to kind of encourage consumption, discourage production. That's what needs to happen on a pretty massive scale here. I think it's going to settle out, but I also think we're also going to have low oil prices for longer than most people expect, which will aid in the recovery, but it is going to be bad news in the energy patch.
Yeah. The U.S. energy patch in particular, right?
Yeah. There's not as many jobs that are at stake in the U.S. Energy sector compared with, say, 2014 when the last time we saw a big collapse in pricing. So it's not as much of a drag in the economy now, but it's still a significant drag, and to the extent that the production gets cut and the pricing moves up, that does help with the economic recovery. Though I imagine from a consumer standpoint, there are benefits from low oil prices, and it will also offset any inflation that comes out of the supply chain constraints that we're facing right now.
Right. All right, Jack, I appreciate your thoughts. Again, we're still in the middle of the COVID lockdown here. Certainly we are in New York, and I hope really around the country, you guys are following your local guidelines. Staying home is the most important thing we can all do. I don't know about you, but I certainly have friends and relatives in the healthcare field, and they are begging us to do our part to reduce the risk to them and to our neighbors and friends. So stay home as much as you can. So stay healthy, take care of your family, and we'll talk to you another time. Thank you very much.
Okay. Bye-bye.